There's a pattern in global finance that has destroyed the currency of every single world empire in the last 500 years. And it happens like clockwork, every 70 to 80 years. The mathematical precision of this cycle isn't theory, it's documented history, written in the rise and fall of the world's greatest powers. And right now, in 2025, the US dollar is 81 years old as the world's reserve currency, older than any of its predecessors when they collapsed. It's not just following the pattern, it's overdue. In 1640, the Spanish Empire controlled global trade with their silver coins. Within 80 years of peak dominance, they defaulted on their debts 6 times and lost their monetary empire. In 1700, the Dutch guilder was the world's most trusted currency, backed by the financial innovations of Amsterdam. Within 75 years, war debt destroyed Amsterdam's financial supremacy forever. In 1920, the British pound sterling ruled 80% of global reserves, the backbone of an empire where the sun never set. Within just 25 years, it lost its crown to the dollar. Notice how each collapse happened faster than the last, from 80 years to 75 years to just 25 years. And here's what should terrify you. The United States has already completed 5 of the 7 stages that destroyed every previous reserve currency. We're in stage 6 right now. This is the story of how reserve currencies die, why the smartest empires in history couldn't escape this pattern, and exactly what history says happens to the dollar by 2026. Before we dive into history, let me reveal the 7 stages that every reserve currency follows to its death. Stage 1. Ascendancy through trade dominance. A nation's currency becomes globally preferred due to trade supremacy. Superior naval or military power enables trade route control, and the currency is used for over 30% of global trade. Stage 2. Debt-financed military expansion. The empire uses its currency privilege to fund military dominance through debt. Other nations must hold the currency, enabling unlimited borrowing. Military spending exceeds 15% of the budget, and persistent deficits begin. Stage 3. The Triffin trap activates. To supply the world with currency, the issuer must run permanent deficits. Global demand for reserves forces the creation of more debt. Trade deficits become structural, and debt to GDP exceeds 50%. Stage 4. Currency debasement accelerates. Money printing increases to fund both domestic and military spending. Political pressure prevents fiscal discipline. Money supply growth exceeds 10% annually, and inflation pressures build. Stage 5. Alternative systems emerge. Other nations begin creating parallel payment systems. Loss of trust drives innovation in alternatives. Bilateral trade agreements start excluding the reserve currency. Stage 6. The confidence cascade. Central banks begin diversifying reserves away from the hegemon. Small moves by many actors create a self-reinforcing trend. Reserve share drops below 60%, and central banks accumulate gold. Stage 7. The monetary reset. A crisis triggers rapid abandonment of the old system. War, default, or devaluation destroys remaining confidence. The result: currency crisis, new monetary arrangements, and a 40 to 60% devaluation. Now, let me show you how this pattern destroyed 3 global empires and why America is next. Let's start with the Spanish Empire and their pieces of 8, the first truly global currency. At its peak, Spanish control over New World silver was absolute. The legendary mines of Potosí in modern-day Bolivia produced 60% of the world's silver. This wasn't just wealth, it was the foundation of the first global monetary system. Spanish pieces of 8 became so universal that they were accepted from London to Canton, from Stockholm to Cairo. By 1600, Spanish pieces of 8 accounted for the primary currency in trade across 4 continents. But beneath the endless flow of silver, the rot was already beginning. This is stage 1 of every reserve currency death, ascendancy through trade dominance. Spain didn't just stumble upon wealth, they created a global trade network through conquest. The Manila galleons connected Asia to the Americas, while the Atlantic treasure fleets linked the New World to Europe. Spain controlled the choke points of global commerce. By 1580, 85% of European silver came through Spanish ports. The Casa de Contratación in Seville regulated this flow with bureaucratic precision. Under Charles V, and later Philip II, Spanish monetary dominance seemed unshakable. The Real de Oro, piece of 8, contained exactly 25.56 grams of silver, a standard so reliable that even England, Spain's enemy, used them for international trade. Chinese merchants in Manila demanded payment exclusively in Spanish silver. Stage 2. Debt-financed military expansion. Here's where the pattern becomes deadly. Spain's Habsburg rulers engaged in endless wars. The Dutch revolt lasting 80 years. The 30 Years' War devastating Central Europe. Constant conflicts with the Ottoman Empire, and attempts to invade England. The Army of Flanders alone consumed 3 million ducats annually, more than the entire revenue from American silver some years. The Fugger banking family and Genoese financiers initially funded these adventures, confident in Spanish silver backing, but by 1575, military expenses consumed 140% of crown revenues. That's not a typo. Spain spent 40% more than everything it collected, including the endless stream of American silver. Stage 3 manifested uniquely for Spain. The colonial deficit trap. This is Spain's version of what economists now call the Triffin dilemma. To supply the world with silver currency, Spain had to export its wealth. But this created a devastating paradox. Spanish industry collapsed as cheap silver made imports more attractive than domestic production. The price revolution saw prices in Seville rise 500%, while wages stagnated. Dutch and English manufacturers captured Spanish colonial markets, selling goods to Spanish colonists for Spanish silver. Spanish merchants became mere intermediaries. Silver flowed into Seville and immediately flowed out to pay for imports, military expenses, and debt service. Spain became a mere conduit, producing the currency but not the goods. Stage 4. Currency debasement. But not of silver, of copper. Unable to debase the silver that maintained their international credibility, Spanish kings debased the domestic copper currency called velón. The debasements came in waves: 1599, 1603, 1617, and 1621. Each time, the copper coins contained less actual copper and more alloy. By 1626, it took 3 copper reals to buy what one bought in 1600. The arbitristas, Spanish economic reformers, warned that the kingdom is being destroyed by bad money, driving out good. But the crown needed funds for its wars. The pattern was inescapable. Stage 5 saw alternative systems emerge. The Dutch created new Baltic trade routes bypassing Spanish control. English privateers established a parallel Atlantic system based on sugar and slaves. Amsterdam emerged as the new financial center, offering innovations Spain couldn't match: commodity exchanges, maritime insurance, and joint stock companies. By 1635, more European trade was financed in Dutch guilders than Spanish reals. The Whistle Bank of Amsterdam became more trusted than Spanish royal mints. Stage 6 brought the confidence cascade. Italian bankers began refusing Spanish crown bonds after the fourth bankruptcy. German merchants demanded payment in non-Spanish coins. The Spanish crown defaulted 6 times: 15, 57, 1575, 1596, 1607, 1627, and 1647. Each default destroyed more confidence. 6 defaults in 90 years, each one making Spanish paper promises worth less than the previous. Stage 7, the monetary reset, came with military defeat. The Treaty of Westphalia in 1648 marked Spain's loss of European dominance. Portugal's independence in 1640 broke the colonial empire. Spanish share of European trade collapsed from 55% in 1600 to just 15% by 1650. The human cost was staggering. Castile lost 25% of its population between 1600 and 1650. Spanish textile production fell 75%. The empire that once dominated the world couldn't even clothe its own people. Over 500,000 Spanish soldiers died in endless wars that achieved nothing but bankruptcy. The defeats mounted. Rocroi in 1643 shattered the myth of Spanish military invincibility. Portugal's restoration ended the dream of Iberian unity. Dutch independence was formally recognized, a humiliation for the empire that once ruled the Low Countries. Today, Spain's GDP per capita is 40% below the EU average. The nation that once controlled the world's money supply is now a peripheral European economy. The lesson of Spain is stark. Infinite money means nothing if you destroy your productive capacity chasing military dominance. Let's jump forward to the power that replaced Spain. The Dutch learned nothing from Spain's collapse. In fact, they thought their innovative financial system made them immune to the pattern, and their fall would come even faster, just 75 years from peak to collapse. This time, A small republic would show that size doesn't matter when you control global finance until the pattern catches up. The Dutch Republic, 7 small provinces that conquered global finance. While Spain drowned in silver and debt, Amsterdam became the Wall Street of the 17th century. The Dutch East India Company, the world's first public corporation, was worth 78 million guilders at its peak, 10 times England's entire GDP. The Amsterdam Stock Exchange, the Whistle Bank, commodity markets. The Dutch invented modern finance. By 1650, Amsterdam processed 50% of Europe's trade, despite the Netherlands having a population of just 2 million. Dutch per capita income was 50% higher than England's and double that of France. Ships flying Dutch flags dominated every sea route that mattered. But the same pattern that destroyed Spain was already beginning. Stage 1 manifested through financial genius, not military conquest. The Dutch didn't need vast armies. They had something better: financial innovation that made everyone dependent on Amsterdam. Joint stock companies allowed pooled investment in global ventures. Maritime insurance made risky voyages profitable. Commodity markets in Amsterdam set global prices for grain, timber, and spices. The Baltic trade showed Dutch dominance perfectly. By 1650, Dutch merchants controlled 80% of all grain, timber, and naval stores flowing from the Baltic to Western Europe. Every major European power depended on Dutch ships for critical supplies. The VOC alone employed 50,000 people and commanded a private navy larger than most national fleets. Stage 2. The Dutch had to spend even more on defense than Spain, proportionally. A small nation, surrounded by larger powers, the Netherlands maintained the most expensive military relative to its size in European history. The wars of Louis XIV forced military spending to consume 80% of the state budget by 1670. The 3 Anglo-Dutch wars lasted from 1652 to 1674 and cost fortunes in naval construction. Each ship of the line cost 100,000 guilders. The land defences, the famous Dutch waterline, required constant maintenance. Unlike Spain with its vast empire to tax, the Dutch had to fund everything from a tiny geographic base. Stage 3. The Guilder Trap. Amsterdam had to finance all of Europe's trade, creating the same dilemma that destroyed Spain. To maintain the guilder's reserve status, the Dutch had to export capital continuously. Dutch investors funded Swedish mines, Russian timber operations, French manufactories, everything except Dutch industry. Dutch disease emerged 2 centuries before economists named it. As finance grew, manufacturing declined. Why build things when you could make more money trading them? Dutch shipbuilding, once supreme, lost ground to English and Swedish yards. Capital fled productive investment for speculation in tulips, colonial ventures, and foreign bonds. Stage 4 manifested not through debasement, but credit explosion. The Dutch were too sophisticated to debase their currency like Spain. Instead, they created credit bubbles. The acceptance rate at the Whistle Bank, supposedly backed by gold, expanded far beyond actual reserves. Financial engineering replaced monetary discipline. Stage 5. London emerged as the alternative. After the 1688 Glorious Revolution, when Dutch William III became King of England, English financial markets began adopting Dutch innovations. The Bank of England, founded in 1694, copied the Whistle Bank, but with the backing of a larger nation. English joint stock companies challenged Dutch monopolies. Stage 6 arrived with shocking speed in 1672, the Ramp Jar, or disaster year. France, England, Munster, and Cologne invaded simultaneously. The Dutch flooded their own country to stop French armies. Confidence in Amsterdam evaporated overnight. Foreign merchants pulled deposits from the Whistle Bank. The guilder's premium vanished. Stage 7. The monetary reset came quietly. William III's accession to the English throne in 1688 created a peculiar situation, the Dutch ruler taking Dutch capital and expertise to build up England's financial system. The best Dutch bankers moved to London. By 1720, London had overtaken Amsterdam in trade finance. The reversal was complete. Amsterdam's share of European finance fell from 60% in 1650 to 20% by 1750. Dutch maritime employment collapsed by 60%. The nation that once dominated global trade became a rentier economy, living off past investments. The Fourth Anglo-Dutch War lasted from 1780 to 1784 and revealed the truth. The Dutch couldn't even defend their own shipping. The VOC, once worth 78 million guilders, went bankrupt in 1799. The Wisselbank, foundation of Dutch monetary supremacy, was revealed to be insolvent. Today, the Netherlands remains wealthy but peripheral. Amsterdam is a tourist destination, not a financial command center. The pattern accelerated, just 75 years from dominance to irrelevance, compared to Spain's 90. The lesson: financial innovation cannot overcome the fundamental pattern of reserve currency collapse. The British watched both Spanish and Dutch collapses carefully. They built the most sophisticated monetary system yet seen, the gold standard, the Bank of England, the Royal Navy, to protect it all. They created an empire where the sun never set, backed by the world's most trusted currency, and still fell to the same pattern, but in just 45 years of true dominance. Let me show you how even perfection couldn't stop the cycle. The British Empire, where the sun never set and the pound never failed. By 1913, pound sterling comprised 80% of global foreign exchange reserves. London was the undisputed global financial centre. Every major trade, from Argentine beef to Indian cotton, was financed through London's merchant banks. The city's acceptance houses cleared half the world's commerce. The gold standard provided rock-solid stability. £1 equaled 113 grains of gold for over 200 years. This wasn't just monetary policy. It was a religion. British economic supremacy seemed as permanent as the Royal Navy's dominance of the seas. But in just 31 years, 2 wars would destroy what took centuries to build. Stage 1. Trade dominance came through both empire and industry. Britain controlled 25% of global manufacturing in 1880 and 30% of world trade. The formal empire covered a quarter of the Earth's land surface, while the informal empire of sterling extended even further. From Shanghai to Buenos Aires, business was conducted in pounds. Stage 2. Military expansion costs mounted decades before collapse. The Boer War lasted from 1899 to 1902 and cost £250 million, a shocking sum that required the first income tax in peacetime. The naval arms race with Germany saw the Royal Navy's budget double between 1900 and 1914. The two-power standard, maintaining a fleet larger than the next 2 navies combined, became ruinously expensive. Stage 3. The sterling trap emerged clearly. To function as the global reserve, London had to provide endless credit to the world. British capital built railroads in Argentina, mines in South Africa, and ports in India. By 1914, 40% of British wealth was invested overseas. Meanwhile, British industry lost competitiveness as capital fled abroad seeking higher returns. Stage 4. Currency debasement began the moment World War I started. On August 4, 1914, Britain suspended the gold standard, temporarily. The money supply expanded 100% during the war. Despite returning to gold in 1925 at the pre-war parity, the damage was done. The pound was no longer as good as gold, but merely a promise to pay gold. Stage 5. The dollar emerged as the alternative during the 1920s. America emerged from WWI as a creditor nation, while Britain owed £850 million, 40% of GDP. New York began competing with London for trade finance. By the mid-1920s, the dollar had already overtaken sterling in global central bank reserves, a fact hidden by British statistics counting the entire empire as one unit. Stage 6. The confidence cascade began with the 1931 crisis. On September 21, 1931, Britain abandoned the gold standard permanently. Within weeks, 25 countries followed. The sterling area shrank as dominions sought alternatives. Central banks that had held pounds as reserves took massive losses, destroying trust forever. Stage 7. The monetary reset came at Bretton Woods in July 1944. With British negotiator John Maynard Keynes essentially begging for American loans, the conference formalized what markets already knew. The dollar was the new king. Britain got a face-saving position but no real power. The torch had passed. The numbers tell a brutal story. Britain owed America £3.5 billion by 1945, 240% of GDP. The empire that financed the world now begged for loans. Military spending fell from 40% of GDP in 1945 to 5% by 1955. Industry collapsed. British share of world manufacturing fell from 25% to 10% in a generation. The empire dissolved with shocking speed. India gained independence in 1947, taking a quarter of the empire's population. The Suez Crisis of 1956 proved Britain could no longer act independently. American financial pressure forced withdrawal. Sterling devaluations followed. 30% in 1949, 14% in 1967. Today, the pound comprises just 4% of global reserves. London remains a financial centre, but as an offshore platform for other people's money, not as the commander of its own. The lesson is clear. Even the most sophisticated financial system, backed by the largest empire in history, fell to debt and war in just 45 years of challenged dominance. 3 empires, 3 patterns, 3 collapses. Spain took 90 years from peak to fall. The Dutch just 75 years. The British, a mere 45 years of true dominance. The pattern is accelerating with each iteration, and the dollar is now 81 years old. The U.S. has completed 5 of the 7 stages, deep into stage 6. Let me show you exactly where America is in these 7 stages. The U.S. dollar has been the world's reserve currency since Bretton Woods in 1944. That's 81 years, already older than any predecessor at collapse. The system born from British exhaustion is now showing identical symptoms, and every single warning sign is flashing red. We've completed 5 of the 7 stages. We're deep into stage 6. Let me prove it to you, stage by stage. The Bretton Woods system made the dollar central to global trade. The Marshall Plan flooded Europe with dollars, creating dependency. The petrodollar agreement with Saudi Arabia in 1974 ensured all oil traded in dollars. By 1960, 60% of global foreign exchange reserves were in dollars. The dollar became central to global trade. America has spent $8.5 trillion on post-9/11 wars alone. The defense budget exceeds $800 billion annually, larger than the next 10 nations combined. Military bases in 80 countries require constant funding. Like every predecessor, America funds this through debt, enabled by reserve currency privilege. Military spending through debt. Check. Robert Triffin identified this paradox in 1960. To supply the world with reserve currency, America must run persistent deficits. The U.S. has run trade deficits every year since 1975. Cumulative trade deficits now exceed $18 trillion. The world needs dollars, so America must spend more than it earns, forever. America must run deficits to supply dollars. Check. The Federal Reserve's balance sheet exploded from $800 billion in 2008 to $8.5 trillion by 2022. 40% of all dollars in existence were created since 2020. Money supply growth averaged 15% annually during pandemic responses. Interest rates held at 0 for a decade destroyed price discovery. Massive money printing. Check. China launched CIPS in 2015, processing $14 trillion in 2023. The digital yuan pilot programs cover 260 million people. BRICS nations are developing a common payment system. Bilateral trade agreements increasingly exclude dollars. China, Russia, India, UAE, Brazil, Argentina. Parallel systems operational. Check. This is where we are now. Central banks bought 1,136 tons of gold in 2022, the highest level since 1967. Dollar share of global reserves fell from 70% in 2000 to 58% in 2024. Saudi Arabia openly discusses accepting yuan for oil. Russia and China trade entirely outside the dollar system. Turkey repatriated all gold from the U.S. The confidence cascade has begun. We're here now. History says the trigger comes from unexpected directions. A Taiwan crisis that splits the global economy. A failed treasury auction as foreigners refuse to fund American deficits. A BRICS currency backed by gold and commodities. When confidence breaks, it breaks suddenly. Britain lost reserve status in just 18 months. If the pattern holds, and it always has, we're looking at 2026 to 2027. History says we have 1 to 2 years maximum, but the evidence doesn't stop there. U.S. federal debt reached $35 trillion, 130% of GDP. Foreign holdings of treasuries are declining. China reduced holdings by $300 billion, Japan by $200 billion since peaks. BRICS expanded to include Saudi Arabia, UAE, and Ethiopia, now representing 40% of global GDP and 45% of population. Germany repatriated 674 tons of gold from New York. Netherlands brought home 122 tons. Even Poland is repatriating gold. When allies don't trust you to hold their gold, confidence is already broken. IMF special drawing rights discussions are intensifying, with open talk of SDRs replacing dollar dominance. Every metric that preceded previous collapses is present now. What would Stage 7 look like for America? History provides the template. A treasury auction fails when foreign central banks don't show up. The Fed steps in as buyer of last resort, creating a death spiral of money printing. Dollar devaluation of 40 to 60% against other major currencies follows within months. Import prices explode overnight. Gasoline, electronics, clothing. American standard of living collapses as the nation discovers what things really cost without reserve currency privilege. Pension funds holding treasury bonds lose half their value. Savings accounts maintain their number of dollars but lose purchasing power catastrophically, like Britain after 1945, but compressed into months, not years. Digital systems mean confidence evaporates at internet speed. The pattern doesn't lie. Spain thought their silver was infinite. The Dutch thought their innovation was unbeatable. Britain thought their empire was eternal. Each time, the pattern won. Maybe America is different. Maybe technology changes everything. Maybe network effects preserve dollar dominance. But the math says otherwise. Let's review what we've learned. Every reserve currency follows 7 specific stages to its death. Spain took 90 years from peak to collapse. Netherlands, 75 years. Britain, 45 years of clear dominance. The pattern accelerates each time as global systems become more interconnected. America, 81 years and counting, already in stage 6 of 7. History is screaming at us. Each collapse happened faster than the last. In the digital age, confidence can evaporate in days, not decades. When central banks move, they move together, coordinated by instant communication. Bank runs happen at the speed of electronic transfers. What took Spain 90 years might take America 90 days. The end isn't coming. The end is already visible on the horizon. Maybe America finds a way out. Maybe we cut spending, pay down debt, restore confidence. Maybe the dollar's network effects are too strong. Maybe this time really is different. But history says otherwise. Math says otherwise. And the pattern has never failed. If this opened your eyes to where we are in the sequence, subscribe. When stage 7 triggers, and history says it's coming, you'll want to understand what's happening as it unfolds. Because those who understand the pattern can prepare. Those who don't become its victims. The pattern has spoken for 500 years. The only question is, are you listening?